Good evening and a very warm welcome to First Issues. Friends, colleagues, radio, TV, social media, and now even road shows. Everybody seems to be talking about the BTCL IPO listing and the purchase of their shares, especially in the 2 weeks since they were finally put up for sale.
Since the offer opened on Monday, there's been a lot of interest from Botswana. They've been coming to our offices to get the prospectus, and we also visited Baker's Bank where they're supposed to be paying for the shares and presenting the applications. So many Botswana are coming in. This is a very exciting time.
How many lining up for that coveted 200-plus page prospectus will actually read through it before filling in the application forms enclosed? Of those that do make an effort to read it, how many will have the know-how to analyze it before deciding whether or not it is an offer worth their time and money? Last week we looked into why this listing took so many years longer than planned to finally materialize, and at the actual process of application for these particular shares. This evening we hope to provide a voice of reason amidst all this excitement and help people understand the realities of investing in equities, including the factors that are looked at when gauging which shares to invest in. When looking to buy shares in a company, we are first asked to ask ourselves questions like, will the goods and services this company provides be in demand in the future? Are there opportunities for this company to grow? Who are the company's competitors, and is it in a strong position? Because as previous guests on our show, including representatives from the Botswana Stock Exchange, have told our viewers in the past, when you buy a share, you're buying a small part of a company and a share in any profit the company makes. Kennedy Khomanyane from Stockbrokers Botswana, who are the sponsoring brokers of the BTCL IPO, and Kwabena Antwi, an investment analyst from Afina Capital, are here this evening to explain what the implications of that ownership are. Welcome back to First Issues, as tonight we look into the true implications of purchasing those much talked about BTCL shares. In the nationwide excitement over the initial public offer for shares in the country's first successfully privatized parastatal, we wonder how many people truly understand the type of investment offered by equities, or even how one can expect to make money from the ownership of shares.
I would say shares as an investment will give you medium to long-term returns. And one of the ways in which you get a return from shares is through capital appreciation, or in simpler terms, a rise in the share price of the company in which you bought shares. That's one aspect of your return. Then the other way in which you get a return is through dividends. When the company makes a profit, it usually pays what is called a dividend. Now that dividend is paid periodically. It could be 6 monthly, it could be annually, but most companies, at least on our exchange, pay dividends every 6 months. So those are the two ways in which you benefit from buying shares, through dividends and through an increase in the price of the shares that you purchased. But of course, those shares come with a risk as well, because the share price can also go down, which means you can actually experience capital losses. So, there's two ways in which a share price can move upwards or it can move downwards. But the long-term expectation or the long-term hope is that in the long run, the share price will increase as the business grows, as profits rise, as the company gets more customers or gets more clients. That's how you hope to benefit from any investment in any company through buying shares. So in the long and short, that's basically how you gain from buying shares.
The minimum buy-in for the BTCL IPO is 1,000 pula to allow for as many Botswana to participate as possible. But there are some who question whether that minimum is worth investing, whether it will yield anything at all.
Well, the one thing about initial public offerings is you get to move in just as companies listing, and usually they will try and give investors a bit of a discount to what the company is worth, ideally. But at the same time, it all depends, different things for different people. If 1,000 is a lot to someone, and investing 1,000 probably would be enough. For some people, it's different. At the same time, it also depends on how you assess it, and do you feel it'll be as profitable, or do you believe in management as much as the rest of the market does? Because if you don't, you'd probably buy less, and if you do, you'd probably buy more. So it's entirely an individual decision, and it'll depend on one's financial situation at the time.
Well, I think the minimum amount is actually a reasonable amount because it makes it accessible to a very large number of people. I mean, if you place it in simple layman's terms, 1,000 pula will probably buy you a goat. And I think that's how people can relate to that scale of investment. 1,000 pula being a goat. So if you start with 1,000 pula, I would imagine that's a reasonable amount to invest in shares. You don't really want people to invest 100 pula because the costs of investing such small amounts are quite prohibitive when you look at the fixed charges like handling fees and commissions and stuff like that. So I think 1,000 pula is a good starting point, although I would encourage people to invest more than 1,000 pula, or at least invest as much as they can, or as much as their resources allow. So I think 1,000 pula is a reasonable start. If you speak of 1,000 pula, going forward, you could be looking at perhaps doubling your investment in the next 5 years or more, or even tripling, depending obviously how well the company that you've invested your money in. It could be better than 3 or 5 times your original investment. So I think 1,000 is a good start, but obviously you can't guarantee the sort of return you'll get in the long run. But I think you would be looking at, in practical terms, doubling your money in maybe 5 years or even less than that. You could double your money in 2 years, obviously depending on how well things go. So I think, 1,000 is a reasonable amount to start with.
We here at First Issues love the fact that the nationwide excitement over this listing has gotten people from all walks of life finally interested in investing in shares, and hope it won't be a once-off venture but an option they will continue to utilize. That being said, what factors must one always consider when looking to invest in the shares of any company?
I think the most important thing is management. You need to decide if the management have the necessary skills, if they're capable, and if they have the foresight to execute the strategy of the company. That's the most important. The one thing after that is funds. Do they have the appropriate funding to actually capture this? So it's very good to have a strategy, but if you do not have the capital to actually execute it, then the strategy is a bit pointless. The next thing you'd look at is the market trends. So in this market that this company is in, is it going up or is it going down? Is it being substituted by another product, or is there increased regulation? After that would be actually, how does the company itself run? Its operating costs high, low, in relation to the market, as well as its profitability at the end of the day. And what really drives that profitability? Is it because it's a low-cost provider, or is it because it's able to actually gain more value and higher revenues by focusing on certain segments? So those, in a nutshell, would be the key things to look at when looking at any company.
Well, the most important thing, at least if you're an investor, is to look at the outlook going forward, or the outlook for the industry in which you're investing. And in this particular case, we're talking about the mobile industry. And we foresee the industry expanding over time as the universe of services that they offer increases. So you look at growth for that particular industry, but you also look at things like the price at which you enter, the price entry at which you acquire your shares. We normally talk of something like a price earnings ratio. In other words, the share price divided by the earnings per share of that company. The lower the price earnings ratio usually implies that you're getting a good price. So those are some of the factors you need to look at. You also need to look at the balance sheet of the company. So you have to examine the accounts that are posted by the company every year or every 6 months and see what the balance sheet looks like. Now, if you don't understand the balance sheet, you can always consult a professional, maybe a banker or a stockbroker or any finance professional to help you understand some of the figures that are provided in that balance sheet. It will essentially tell you what the structure of that company looks like in financial terms. Whether there is debt in that company, naturally you want to avoid or at least limit your exposure to companies that are highly indebted, because that makes them riskier. So you are looking at maybe reasonable levels of debt or lower levels of debt. Of course, debt is very, very important in terms of allowing the company to grow without being limited by the capital resources it already has. But you don't want to be exposed to a company that has too much debt. So those are some of the things that you look at. You also look at the economy, the wider economy. Is the economy growing? That also helps to gauge whether what you're investing in is going to grow over time. You always want to see positive economic growth. You always want to see higher levels of growth. So economic growth is very, very important in terms of whether you should or should not invest. You also look at the rate at which the company pays dividends. Usually you want a company to pay as much a proportion of its share price in the form of dividends as is practically possible without jeopardizing its ability to grow. So if, for example, you're looking at dividend yield of 2%, it might seem low, but if that company is growing those dividends over time, then it's not a low dividend yield. Of course, you'll be attracted by companies with higher dividend yields, maybe 5 or 6% if you compare that to a bank deposit. And you think, that's actually more attractive. But that doesn't necessarily guarantee that it's a better option, because that high dividend yield might imply that the growth going forward is actually less than maybe a competing or alternative investment. So those are some of the metrics you look at in terms of whether you should invest in a company or not. Now, your dividend yield is normally calculated by dividing the dividends per share paid by the company, divide that by the share price. In other words, whatever the company is paying dividends per share, you divide that by the share price of that company. If you take the example of BTCL, for example, if it pays 5 tebe in dividends next year, and you bought at 1 pula per share, your dividend yield will be 5%, which I think is quite competitive when you compare to maybe a bank deposit or maybe a competing alternative. So a dividend yield is actually one of the useful indicators, among many other indicators, of course. But you have to accept that there is no single indicator that will tell you whether something is a good investment or not. So yeah, there's a myriad of things to look at, but those are probably some of the key factors you might want to look at.
How can the layperson assess whether the management of a company they are interested in investing in is one they can actively put their trust in, as Kwabena has just advised people to do, seeing that unlike as with brokers, most people do not have direct face-to-face access with such people?
Most listed companies, they will have investor relations. So they're there to assist investors with any questions that they have. They may not meet you, but you are able to at least email your questions and get a response. Another good opportunity would be when companies are having results presentations. As a shareholder, you're always notified of when companies are going to present their results, as well as the AGMs for the companies. And these are very good times that a shareholder, even if you hold one share, you have the right to ask management about the future prospects of the company, and you are entitled to get your answer.
As we draw to the end of this portion of our program this evening, we are reminded that as with many other ventures out there, there is a level of risk associated with investing in shares.
I think, of course, like any other investment, people should understand that shares do carry some level of risk. There is no guarantee that comes with any investment. I can compare it to, say, cattle farming, crop farming, or property. There are always risks. And I think you need to be mindful of the fact that risks do come with buying shares. There's no guarantee that the share price will rise over time, because there could be other factors that are beyond the control of management that might affect the value of the business or even affect the industry on a wider scale, beyond which the management of BTCL might not have any control. So I think in that sense, you need to be cautious in terms of investing. But I would say investing in shares is simply an additional option over and above what you already have. For example, you're just diversifying your investment portfolio when you buy shares in general, by BTCL in particular. So it is just a way of expanding your universe of investment options when you buy BTCL shares or shares in general. So I think that's how people should approach the BTCL investment, that you're actually just expanding your universe of options. You're not reducing your overall risk, but you're managing your risk. Because if your wealth is only invested in maybe 3 sectors or 2 sectors, it's actually a lot riskier than if you're invested in 3 sectors or 4 sectors or even 5 different sectors. So I think that's how people should perceive their investment in BTCL shares, that they're just expanding their options or their investment options.
Welcome back to First Issues. As in the second segment of our program, we continue to look into early childhood development, a crucial factor in the development of human capital. We know that in the positivity that accompanies the beginning of a new year, many have returned to work with renewed vigor, looking to achieve the growth targets they have set for their careers and their businesses. Unfortunately, this goal setting is frequently accompanied by people overcommitting themselves and overlooking the time they will need to invest in their parental duties. Yet positive early childhood development plays a crucial role in human capital and even economic development, as attested to by the work of Nobel Prize winner in economics from the University of Chicago, James Heckman, whose career has included developing models to study unemployment, wage growth, and skill formation. Key findings of the report include the facts that both cognitive and non-cognitive abilities are important for a productive workforce, and gaps that emerge early in a person's life are difficult to change, as well as the assertion that skill begets skill and learning begets learning. Heckman says that since skills are accumulated, starting early and over time investing in young children is an investment into future productivity and even public safety. It is in this context that we focus on the various factors affecting early childhood development this evening, with returning guests Maleshwane Maucho and Lulu Tlale, the founders of Blossoming Child Center, who were previously on the show to instruct us on the major milestones we must all be aware of when raising a child.
The parents, because of our changing world, sometimes are finding it difficult to just parent, because there's just so many different influences. How our parents raised us is a lot more different from how the world that we now see, and that we have to adapt to it, and our kids also have to adapt to it. So our kids end up having challenging behaviors only because their parents, there's a problem there with parents not knowing exactly how to discipline their child, not knowing how to structure their child's day, that there needs to be certain routines and structures so that your child is better able to navigate this really confusing world.
Tonight we pick up our conversation by asking about the developmental challenges that may be particularly difficult to spot in a growing child.
The big one would be with autism, right?
Yes.
Because a lot of times, I think parents ignore or make excuses for a child that's not talking or that doesn't have the appropriate social skills. And maybe the word is not ignore, but they themselves have to come to an adjustment. As a parent, if there's something wrong with your child, there's an adjustment mentally that you have to go through. So for a lot of parents live in denial of what's going on, and then the child doesn't get the help that they need at a very critical stage. Because with especially something like autism, there's a critical period where you could get a lot better results if you work within a certain range, and that's her specialty, so maybe she can expound on that.
What usually happens is that the parent does see those things. They do see those things, and they'll say it to their mother. The parent will say it to the child's grandmother. My child's not really talking properly, and then they'll say to the doctor, I there's just something that's not going really well. But all these people sometimes will actually say to the parent, no, boys usually develop slower, because it's usually boys who get autism. Don't worry about it. And with autism, it's not that well known, and not that many doctors actually know how to spot autism, or even use a tool called the AmChat, which is a tool that doctors abroad would use, in the US and in the UK would use to actually kind of make sure that the child is actually going through all the different milestones. So what happens is that the parent keeps on kind of not dealing with this because it's also very upsetting to deal with it, like Lulu was saying. And eventually, the child is 6 years old, and they're past that really critical 2 to 6 year window period where you really have to do something about the developmental delays that you see with autism.
What makes that age, the 2 to 6 window frame, very critical? What can be done within that time? And please, you said it yourself, autism is so widely misunderstood. Could you give us a graspable understanding of what the disorder is?
Autism it's a neurological disorder, which usually the child will have delays in 3 critical areas: in their social skills, in their communication skills, and also they will have issues with stereotypic behavior. Stereotypic behavior meaning that they'll have certain behavior characteristics that look a little odd to your regular person. So they'll either do something like hand flapping, which is like doing that. They'll stare at lights at the corner of their eye. They will rock, lots of body rocking. Sometimes when you speak to them, they repeat the same thing back to you over and over. And you'll have other children who will not like being held by their parents. Like you'll have a mom who's never hugged their child because their child just cannot stand the idea of being touched by another human being. And they'll constantly cry, have food issues, like not eating whatsoever, like have very, very few things that they eat, you know, or they don't sleep. They sleep 3 hours at night. And then the parent has to wake up in the morning and go to work with a child who slept 3 hours, and most of the time they're jumping up and down in the room, climbing things. Yeah, so that's kind of a little bit of what autism is. From the age of 2 years old to 6 years old, research has shown that a child can actually learn up to 5,000 to 10,000 words a day. So in that gap, including this, that, in the whole thing. And in that critical little gap, that's where we learned most of our language. That's where we learned most of our social skills. That's where we learned most of our, what the social norms are in a lot of our communication. So if we skip that really critical gap within the child's development, you're going to get a lot of issues.